Hi, I'm Jared Nelson from the Investing Channel, and welcome to The Spill. Shares of Netflix fell hard off the company's latest earnings announcement. Earnings beat estimates by 50 cents at $1.33, while revenue was in line with expectations. But management couldn't hide the slower user growth and putrid cash flows. And without growth, Netflix is dead in the water. We haven't taken an opinion one way or another on the company, as it's managed to keep adding subscribers. However, this latest quarter could be the warning shot that could send shares plummeting much further. And the chances are you have a Netflix subscription or know someone who does. With 221.84 million global paid memberships, Netflix is the largest streaming service in the world. Once a DVD mail service, the company invested heavily in streaming and created its own content. Its first hits, including House of Cards and Orange is the New Black, paved the way for a global takeover. Today, the company creates shows in dozens of languages to meet specific niche markets. The biggest challenge for the company has been slowing user additions. In 2021, Netflix saw 50% fewer paid member additions than it did in 2020. True, 2020 was an outlier year due to COVID, yet the additions are nearly 35% lower than 2019's numbers. For Q1, management guided 2.5 million net additional subscribers versus the 6 million expected by the street. It's worth understanding the sheer size of Netflix relative to its competitors. At some point, the company will saturate the market. Currently, HBO Max has 73 million subscribers. Disney Plus boasts 118 million subscribers, 179 million across Disney Plus, ESPN Plus, and Hulu, and Paramount Plus has 47 million subscribers. In the financials, we want to highlight three key points. First, we want to note the improving gross margins. As they grew, management achieved economies of scale, helping deliver gross margins above 40%. Second, revenues grew at a 10-year average of 27.73%. The latest quarterly report shows year-over-year quarterly growth of just 16.28%, which has analysts worried. The last point, which we alluded to earlier, was the high cash burn. It's unusual for a company to turn an EPS profit with negative operating cash flow. Lastly, we want to point out Netflix has $14.7 billion in long-term debt. That's not a lot given the revenues, but it's a problem when you have negative operating cash flows. And it shouldn't come as a surprise that Netflix has some pretty crappy valuations. Yet, given the cash flow issues, we'd expect the price-to-earnings ratios to be worse. At 36 times earnings, they're expensive, but not horrible. In our opinion, this is a 5 out of 10 ranking stock. If you read analyst downgrades, you'd think Netflix would go belly up tomorrow. Far from it. This company dominates the streaming universe. Recent price increases will help them add to the bottom line. We feel that with prudent management, the company can bring down its debt levels, which currently cost them almost $6 billion a year. Where do shares get interesting? Below $300. Click and subscribe to the Spill newsletter to get the full breakdown.